Hey guys, and welcome to today's session, which is all about your Darwin. If somebody in the Discord could just confirm they can see my screen and hear me, that would be absolutely fantastic. I can see there's a few people in the audience already. Just wait for somebody to confirm, and then we'll get started. And I'll check the stream elsewhere just to make sure that it's actually streaming successfully elsewhere. Okay, it looks like it should be all good. Okay, so today's session is about understanding your Darwin at a deeper level or more in depth. And there's many ways that we can do it or frame this view of your Darwin or understand it on a deeper level, because there's often a lot of misconceptions and a lot of confusion about what a Darwin actually is, how it acts, and how it represents your trading. So hopefully today I can squash as many questions or doubts you may have as we kind of evaluate actually what a Darwin is. So to start, my name's Kieran. I'm head of the UK Growth and Business Development for Darwinex Zero. And Darwinex Zero is an AR of Darwinex, our sister company, who is a regulated asset manager and broker here in the UK and in Spain. We hold three separate regulations, or we're regulated by three separate entities: the FCA in the UK, the CNMV in Spain, and by the FSA in the Seychelles. I'm just getting a message in Discord saying that there's an issue with audio. Can somebody else confirm, because it looks good from my side, can somebody else just confirm whether the audio is or isn't working? That'd be really, really appreciated. Can't hear. How about now? Can you hear me now? Can you hear me now? It's saying that I'm speaking on my side, so I'm not sure why the audio won't be working, but I've just... Okay, so it seems in the Discord nobody can hear me, so just bear with me for a second. Okay, so it seems to be working. Right, I'm just disconnecting from the session and joining again on Discord. Hey guys, can you hear me now? Perfect. Perfect. I apologize for that. I did ask for I asked if somebody at the beginning could confirm whether my audio was working, but obviously if nobody could hear me, that's that's why I didn't have a response. So I'm glad that's all sorted. So let's rewind quickly. Just for the guys who have either joined now since I started or couldn't hear me to begin with. This session is all about understanding your Darwin at a deeper level. There's often misconceptions or confusion about what your Darwin actually is, how it relates to your trading strategy, and the purpose of a Darwin, which is what we'll go over today. My name's Kieran, and I'm head of UK Growth and Business Development for Darwinex Zero and Darwinex. Now, Darwinex is a regulated asset manager and broker. We have a head office in Spain, in Madrid, and also in London, UK. We hold three separate regulations from different entities. So we are regulated by the FCA in the UK. We are regulated by the CNMV in Spain and also by the FSA in the Seychelles. We have over 100 million US dollars invested in our platform from third-party capital. And we also have over 10,000 active strategies on our platform. Strategies, not traders, because some traders have multiple strategies or multiple accounts with us. Now, we'll dive straight in and look at what is the point of a Darwin. Why should every trader have a Darwin? Now, the first point is often overlooked by most people because they don't understand the importance of this. okay? And that is that your Darwin is risk adjusted. So no matter how much experience you have as a trader or how good you are as a trader, every trader has an element of risk or behavioral risk, okay? So whether it's emotional control, impulse control, exposure to black swan events, whatever it may be, every trader runs a risk of having a bad period or making bad decisions and losing money because of. And when you have external investors or third party capital under your strategy, you have to have kind of a fail safe, right? And sometimes what we have to do is have somebody else looking after the risk of your strategy. Same as if you're working on a prop desk or a hedge fund or an investment bank, you will always have an independent risk manager sat on the desk. Now, this risk manager they might be trading themselves, but what they're going to be doing is having an unbiased opinion of every single trader on the desk and their positions that they're in. The reason that risk manager is there is to ensure that if something goes wrong, they can close positions, they can manage the trader, and they can effectively take over. Okay. Now, as a retail trader, it's very hard to mimic that kind of environment where you have fresh eyes looking at your trades and looking at your system, and kind of seeing it from an unbiased perspective, which is why probably one of the biggest selling points of a Darwin, even if you don't realize it, is that your risk is automatically looked after by, an unbiased third party. The second benefit of having a Darwin is that it comes under the Darwinex's regulatory compliance. Now, again, this is kind of something that's quite overlooked, but if you were to, as an individual trader, want to attract third-party capital, it's going to cost you a hell of a lot of money and a hell of a lot of stress by trying to get regulated to do so. You're going to have to, depending on the country you're living in or the jurisdiction you come under, you're going to have to fit certain regulatory compliance. And sometimes you have to put up a significant amount of capital. Sometimes it can take years. Sometimes you can get completely rejected. Okay? So, it makes sense that a lot of pros go and trade for, a hedge fund or somebody who is licensed to take in third-party capital. Darwinex makes or builds the bridge between retail traders and professional traders who actually manage capital on behalf of others, because we give you the license and the coverage under the Darwinex brand or Darwinex name. That hence why we hold all the AUM. So you physically never touch the capital as a trader. We basically take the trades from your account and we copy it over to your Darwin, so that your investors get exposure to your trades also, but under a regulated entity. And last but not least, your Darwin is a proven track record, no gimmicks, no fakeness or falsified statements. Again, it's risk adjusted, so you have your standard broker statement, which you can export from MetaTrader, and you also have a risk adjusted statement also, which will hold up if you was to approach a hedge fund for a job, for example, because again, we are a licensed and regulated broker, and therefore a statement or track record from Darwinex will hold up as proof of concept or proof of record. Now, what's really important to note, and there was a big conversation earlier today in the Discord channel, so if anybody isn't in the Darwinex Zero Discord, I highly recommend you to jump in there. There's some great conversations that go on a daily basis, and you will meet some fantastic people. But if you were in there, you'll know there was a conversation earlier about MetaTrader statistics not always aligning with your Darwin statistics. And that is the simple fact that your Darwin, as I've said, is risk adjusted. So depending on the value at risk, I apologize for the coughing fits also, I'm still not over my cold. Depending on the value at risk that you operate at as a trader, your Darwin might be risk adjusted significantly, or it might be pretty much 1-to-1, and you might not see a huge discrepancy between your trades. But let's say you trade with a super extremely high risk level and your Darwin only takes 0.1% of, the position size that you do, or no, that would be, 10% of the position size, sorry. So 0.1x multiplier. Your Signal account, you might double it, and you might be sat at a 200k balance with 100,000 in profit. Your Darwin might only be up 8, 9, 10%. because your trade size has been reduced significantly so that you're operating at the same risk level as everybody else at a 6.5% value at risk. Now, tying that in nicely to the idea of value at risk is our risk engine. So we have a proprietary risk engine that adjusts all of our traders' position sizes to maintain a value at risk of around 6.5% per month across the board. Now, all of that to basically say that we manage traders' risk independently, keeping VAR at a level 6.5% across the board. Every single trader will have their risk standardized to this level. Now, value at risk is a forward-looking metric, not a backward-looking metric. You'll notice we're not using drawdown as a level of or a barometer of risk. For a trader, we're actually looking at, okay, how much exposure does a trader have at any given time so that we can accurately calculate how much risk they're taking to generate a return. Something like drawdown or backward looking metric is very specific to market conditions and timing and luck, chance. Maybe you missed a trade and missed a 10% drawdown. It's very difficult to gauge actually how much risk a trader is taking. To get an idea, okay? Whereas when we use a forward-looking metric like value at risk that measures their trade frequency, position sizing, the volatility, the assets that you trade, all these different factors that are kind of real-time factors and we can measure in real time, you actually get a good understanding of the exposure a trader will take. Now, VAR, or value at risk, estimates how much money you could lose on an investment over a specific period of time under normal market conditions with a certain level of confidence. So this isn't us saying, like, as a matter of fact, you won't lose more than 6.5% as an investor in any given month. We cannot obviously give that guarantee. But what we're saying is there's a certain level of confidence, which we have of 95%, that you're not going to lose 6.5% or more in any given month over a 2-year period. Okay. Now, I understand this can be quite complex and it can sound like a lot of words. And this is why I tend to keep this information to this session only each week, and the welcome sessions, the strategy development sessions, I don't usually talk too much about value at risk because the risk engine covers all of this. You don't have to worry about it on a day-to-day basis. But it's also good to understand how things work. So if you're trading, you're building your record, you're gaining investment, it is good to know how things are working behind the scenes, which is why I think it's really, really important that every trader at Darwinex actually understands what's happening with a risk engine. Now, an example of VAR is if a trader has a VAR of $1,000 with a 95% confidence level over 1 month, that means that there's a 95% chance that the trader will not lose more than $1,000 in a single month. Now, the $1,000 here could equate to a 6.5% value at risk. It's completely interchangeable. But just to keep it super, super simple, we're just saying the dollar amount of your VAR of 6.5% is $1,000. So if an investor allocates capital to you, they know that with a 95% confidence level, that is their max risk on a rolling monthly basis. They shouldn't lose more than $1,000 because their risk is being managed. And that's all it is. It's completely unbiased. But what it does is it creates a level playing field, ensuring that every trader is actually judged based on their skill and not just chance or pot luck, or even about the amount of risk they're willing to take. And the best example of that is, two traders could take exactly the same position, run it for exactly the same time on the same asset. One of them makes 100%, one of them makes 1%. But the only difference between the two traders is one trader put 100 lots on, whereas the other trader put 1 lot on. Does it mean the trader who made the better return is a better trader? Of course not. They did exactly the same thing. They took the same trade, they ran it the same and managed it the same. It was just the risk that was given to the market was completely different between the two traders. So what we do is we try and find a level playing field between both of these guys so that they're judged exactly on the trades that they take and the skills that they have, not just how much size they're willing to put down. Now, you might be wondering, why do we use 6.5%? 6.5% is a very weird yet specific number. So the reason that we chose 6.5%, which actually historically used to be higher, which I'll explain in a moment, but we chose 6.5% because it is the S&P 500's risk level. The S&P 500 operates at a 6.5% VAR on average. And we know that investors are familiar with that risk level and they are proven to tolerate it, year on year, bear market, bull market. Investors are happy to sit with that sort of risk level in the market. So we adjust your strategy to a risk level, knowing that it meets investors' expectations and risk tolerance over time. And the reason we do that is because the last thing that we want is for an investor to allocate capital to you and then pull it a week later because they've had a small drawdown, but because they're operating at a high value at risk, their drawdown's a lot higher. Let's say Darwin's are showing best ranking today. What's going on? What do you mean by that, Rob? So just had a question in Discord. I'm not sure what you mean. But yeah, we used to, I can't remember the exact number, but we had a higher than 6.5% value at risk. I believe it was in the 20%. And what we noticed that was as soon as an investor went through a drawdown, they were likely to pull their funds, and that benefits nobody. It doesn't benefit Darwinex because it goes against our business. We want traders, we want investors, and we want them to connect. It doesn't benefit the investor because they're going through drawdown and they'll pull their capital. And it doesn't benefit the trader because they're just seeing this wild swing in their investor capital. They're seeing investors put money in and then just pull it out and put money in and pull it out. God, I can only apologise for this cough. I hope it goes in the next couple of days. I do think I'm coming out the other side of it now. Anybody who was in the session yesterday will understand how bad I was yesterday, and I actually feel much, much better today. Okay, Rob said, both my Darwin said they're at their best ranking today. The email saying they're in a better position. I had losses on both, though. I'm not 100% sure as to why that is. Send me a direct message, Rob, on Discord. I'll take a look. It might just be an email mistake. Or it could just be that, if you've taken losses today, I don't know. It might have just been the calculation of Darwinia, potentially. But we'll see. Send me a screenshot of the email and I'll take a look into it for you. Oh. Now, as I mentioned, your Darwin statistics aren't always going to be the same as your MetaTrader. In fact, it's very, very rare that they're going to look similar. Unless you have a 1-to-1 or a 6.5% value at risk and therefore a 1-to-1 risk multiplier, which is very, very, very rare. And also as a side note, it kind of doesn't really benefit you chasing a 1-to-1 risk multiplier. What I mean by that is getting a 6.5% value at risk. It's kind of like chasing your tail. You don't need to get a 6.5% value at risk at signal account level because everything that you do is going to be risk adjusted at Darwin level anyway. So just focus on taking the best trades. That's the only piece of advice that I can ever give. Only focus on taking the best trades. Everything else is already done for you. Okay. Now you can see on the screen, we show the return and the max drawdown. As a standard, this only shows your Darwin. But you can see there is a second option where it says signal account. It is grayed out because you can only view your own. So some randomer can't come onto your Darwin and start viewing your signal account statistics. They can on Darwinex.com if you choose to make it publicly viewable. But at D0, you can't. But if you wanted to see your signal account statistics, you could just click on that and it will change and update the statistics. But again, it's not going to update for everybody else. It's literally just going to be for you and you alone. Now, understanding your value at risk. If you've taken a look through your Darwinex Zero dashboard, you'll have seen this chart. If you haven't, I highly recommend that you go and do it because even looking through your metrics on your D0 dashboard, you will learn so much about your system and about how you trade, whether things are working or whether they're not working as well as they could. So I recommend you go and spend some time doing that. But if you were to go on the strategy analysis tab and scroll to the bottom, you'll come across this chart. This chart, it updates in real time and it measures your current value at risk. Okay, so you can see we've made it nice and easy. We've put a big white line across and labeled it as 6.5%. Now, when this chart is above 6.5%, as the arrows indicate, the risk engine will be scaling you down. Okay, so at the beginning, it looks like the trader's operating roughly about 13%, perhaps, maybe slightly higher, maybe slightly lower. At that point, the risk engine's probably going to be cutting your trade sizes in half. Now, what that means is if you're trading 10 lots, the risk engine might cut your trades down to 5 lots at Darwin level. Okay. because you're operating at double the standard risk level. Now, as that value at risk starts to come down over time, you have a second metric, which is your risk multiplier, and it kind of works like a scale, like a weighted scale. As your value at risk comes down, your risk multiplier will increase. Okay. Great question, boss lady. I'll answer that in a second. Because I think there is actually that question at the end, but I'll answer it in a moment for you. As it comes down, your value at risk will decrease and your risk multiplier will increase. And this is why I say it's a bit like chasing your tail, trying to get a one-to-one, because it will be constantly evolving over time. Now, as this trader goes beneath 6.5%, what the risk engine's then going to do is go, you're operating beneath the standard risk level, and therefore we're going to increase your size. So as you go under 6.5%, your trade size is going to start getting amplified. If you get to 3.25% value at risk, your trade size is basically going to be doubled. Okay. I actually ran a test on one of my Darwins recently. It was literally just a test, and I was trading at really low risk, and it was scaling up my trades by, I want to say, over 100 times. And I went through a small drawdown, and the drawdown on the Darwin was huge. But like I say, it was literally, I was just testing some things out. But what's most important about this is that it updates in real time. It takes a 45-day look back period, so it will be adjusting your trades, understanding what you're doing kind of in a more recent way. So it won't be taking into account what you did 3 years ago, basically, but it will be looking back at your previous 45 days. So we had a question in the Discord from Iron Boss Lady, and she said, what is the ideal VAR? Which is a fantastic question. And actually, I don't think there is an answer to that. I also don't think there needs to be an answer to that. There's no good or bad value at risk. It's literally just an unbiased measure of your risk exposure. Now, there's a certain limit to that, I would say. If you're trading and your VAR is above 30%, I would say just be mindful that over the past 13 years, historically what we've seen is traders operating over 30% VAR tend to either blow up or have a large time period where they go into a significant drawdown. If you're happy to handle that, that's absolutely fine. But I know for a lot of traders that can, destroy them or destroy their career because they'll end up giving up after they're in 30, 40, 50% drawdown. So just be mindful. We tend to say traders above a 30%, we know whether it's two months, 2 years, 2 weeks, however long, at some point they're going to have a really, really tough period. That's not to say that they're a bad trader. It's not to say that they won't survive or won't last. It's just that's the pattern that we've seen. But there is no good, there is no bad. The main thing is that you keep it consistent. A consistent value at risk chart tells me that a trader does the same thing day in, day out, week in, week out, month in, month out. And they're the traders who you want to be keeping an eye on. Yeah, exactly that, Typhoon. Couldn't have said it better. Couldn't have said it better. Typhoon said, whatever doesn't impact your ability to execute trades to your system. If high P&L swings impact you, use a lower lot size. If too low of a lot size causes boredom, ramp it up, find out what works for you. Exactly. Iron Bus Lady said, can you keep it below 40% if you ever get there? Yeah, so I presume you know what your value at risk is. But yes, like this will update and you will be able to monitor it and keep it under or above a certain level. The main thing that you will be changing is your position sizing. Okay, so there's a few factors that goes into this calculation, which we'll come on to shortly. But your main one and the easiest one to change, like Typhoon says, is your position sizing or your lot sizes. How we doing, dude? It's been a while. Just completed calibration. Looking forward to the next stage. Awesome. If you need anything, dude, just drop me a message. I'm always happy to jump on and have a chat. But it's good to see you here, man. It's good to see you here. Also, drop me a ticket. I like to keep an eye on it. Okay, another metric that is only viewable to yourself is your Darwin live trades, and it usually shows up on the left-hand side, bottom of your screen. Hal. Okay, perfect. I'm gonna bookmark that. Everybody I know, I always bookmark their Darwin. So just know if I know you, I'm watching how you trade. Well, watching your performance at least. So your Darwin live trades, this is where you can see exactly your contracts that you have open on your Signal account and how it's reflected on your Darwin. So you can see on this example, the Darwin's risk is 2.32, which would tell me they're probably operating with a 2% value at risk or something similar. Yeah, I'm stealing your alpha. I do that with everyone. Typhoon, I just fade everything he does, basically. Your current closure rate will show you how much of the position the risk engine is closed, if it does at any point, which can happen if you have spikes in volatility. It shows you the asset that you're trading. So in this example, Kiwi yen, shows that you're short, how many contracts you are or you have open, and how many contracts your Darwin has open. So you can see, because they've got a positive risk multiplier of 2.32, even though they're trading 1.2 contracts or 1.2 lots at Signal account level, their Darwin's actually scaled it up and opened 2.79 contracts. Now what you can't get confused with here is that's based on a $100,000 account, right? So if you're only allocated $50,000 or 50,000 euros or whatever it may be, just to keep the maths simple, because mental maths isn't my strong point, your Darwin wouldn't be open with 2.79 lots. It would be open with 50% of that. Okay. So because I actually had this conversation recently, obviously there's two parts to this calculation, right? You have the initial risk multiplier. So if your risk multiplier is 1-to-1, it's going to be taking the same size. But then you have the balance multiplier. Is your Darwin the same balance as your Signal account? If yes, okay, it will be literally trading the same size. If not, obviously there's going to be a balance multiplier there. So if your Darwin is twice the value of your Signal account, it's going to be trading twice the size. Otherwise, the percentages, they wouldn't add up, right? So that's just important to note. It's kind of commonsensical, but we actually had this conversation the other day, and I was surprised that some people thought it would be trading the same size, which wouldn't make sense, because if you're trading a $10 million in investment, you want it to be trading more size than what you would on a $100,000 account, right? So again, going back to the example of the two traders that I gave you earlier on in the session, we have trader A who trades with too high of a lot size, and we have trader B who trades with too little of a lot size. Now, what the risk engine is going to be doing is looking at both of these traders and the other 10,000 traders we have, or 8,000 or 9,000 traders we have competing in Darwinia, and it's going to go, okay, let's scale them all to the same level of risk. So trader A, who trades with a significant amount of risk, the risk engine is going to be scaling them down. Trader B, who trades with too small of a risk, the risk engine is going to be scaling that trader up until they meet in the middle and have a standard risk level of 6.5%. Now, Maplin's asked in the Discord how much is considered higher lots and how much is considered lower lots. So it's all relative to the asset you trade. It's all relevant to the asset you trade, how long you're in the trade, etc., etc. What's really the key here is your value at risk. So it's all relative. Just, I would say with Darwinex specifically, trade with as low a size as you possibly can, because again, the risk is all being accounted for anyway. It's all being adjusted by the risk engine. So I wouldn't worry about trading with, like, trying to flip your Signal account or what have you. All I would say is try and trade with size that you're gonna make 2-3% a month and keep your drawdown 5-10%. You don't need to go crazy. Trade well, that is the key. Exactly that. Your only focus here should be on taking the best trades and not doing anything else, basically. The risk is covered. Just manage your risk, of course, but the risk engine covers your position sizing. So just focus on sending the best trades that you possibly can, and the risk engine will do the rest. Having said that, if you're trading with 100 lots and then you notice your value at risk is 70%, 80%, I would think very, very carefully about continuing doing so. I would slowly start to bring it down over time, to maybe 90, 95 lots, 90, no, I've done it the wrong way there, 95 lots, 90, 85, 80, and so on and so forth. The reason I would do that is because you don't want to run out of margin, you don't want to blow the Signal account, it's never going to benefit anybody. But there is no high or low lots. It's just kind of in relative to each other. So the four main factors that affect your strategy's value at risk is number one, asset volatility. So obviously every asset has its own kind of level of volatility. So euro dollar, for example, is not comparable to Bitcoin because Bitcoin has a much higher ATR, it has a much higher inherent volatility, and generally is going to move a lot faster. It doesn't always, but for the most part, it means more traders will lose money on an asset that is in higher volatility. So it has a higher value at risk. Again, that's just a generalization. It doesn't mean every Bitcoin trader is high risk and every euro dollar trader is low risk. I'm just saying as a general rule of thumb. Number two is your trade frequency. So really here, what we're doing is measuring your exposure to the market. The more active you are, the more chance there is of things to go wrong, the more risk exposure you have. And whilst it's not a huge factor to determine your risk level, it's still a factor. Somebody who trades 100 times a day compared to somebody who trades once a month, there's a lot more things that can go wrong for the guy trading 100 times a day. Whereas there's only once a month something could go wrong for the swing trader. Again, doesn't mean they're a better or worse trader. It's just an unbiased way of measuring somebody's risk exposure. Number three is trade duration. Again, it kind of works off the same premise, is that the longer you're in a trade, the higher chance there is of something going wrong, or having a round trip, or having a winner turn loser, whatever it may be. The less amount of time you're in the market is beneficial from a risk perspective. But again, this is so marginal that I don't think it really matters, or it's not something that you should be concerned with changing. Don't go, I've got a high value at risk, so I'm going to start cutting all my trades after I've been in the market for a minute. It's such a minute factor. But the biggest one is your position sizing. So the rest is kind of like how I like to think it's like an inherent value at risk. It's your strategy. That's the level of risk that it is. Whereas your position sizing is actually something that you can change and play around with. So it's the one that I would change if you wanted to lower your VAR. I would start to scale your trade size down or your position size down. And I would do it over an extended period of time because, as I mentioned earlier, the risk engine looks back over a 45-day period. So instead of dropping from 100 lots to one lot in one go or one trade, I'd be doing it gradually. Drop from 100 lots to 97.5 to 95 to 90 to 85 to 80 to 60 and so on and so forth. That way you'll be bringing your VAR down slowly and your risk multiplier will be increasing slowly also. That's the main factor that would affect your value at risk. Now, some commonly asked questions that we have, especially after these sessions, and whilst I'm going through these, if you do have any follow-up questions, please just pop them in the Discord chat and I'll be happy to go over them. Number one is, when will my Darwin be listed? So we always list Darwins over the weekend. So our system processes them over the weekend, and then on the following Monday, they will be listed and live. So if your Darwin finished today, for example, and you come out of calibration phase today, following Monday, which would be in what? Friday, Saturday, Sunday, 4 days, your Darwin will be live. A follow-on to that is, should I stop trading whilst it's being listed? I am never a fan of stopping trading for external factors. Your statistics and your trades will still be counted towards your Darwin whilst it's being listed, so there's no reason to stop trading. But also, people stop trading when they've hit a certain level for allocation, or hit enough for performance fees or whatever it may be. And whilst I understand why people do that, I don't always think it's the smartest choice. You guys are here because you want to be professional traders and you want to show that you can do this long term. Don't let short-term incentives stop you from that long-term goal. So don't stop trading just because you've hit a certain rate in this month, or you've made $500 in performance fees. Just keep trading whenever your system tells you to trade, without overtrading, of course. Number three, should I increase or reduce my risk? I feel like we've covered this already quite a lot. The only time that I would say it's worthwhile reducing your risk is if you are kind of at a critical level on your value at risk, above 30%. Well, I don't want to get anybody scared. 30% and above, it's not critical. I'd say 60, 70, 80%, that's probably where you get into critical levels, and I would be concerned. But if you are above 30, then yeah, maybe it's worthwhile reducing it over the next few months. It's nothing to be panicked or concerned about, but just know that there is a chance that you're going to go through a significant drawdown. and at least reducing your risk is going to mitigate that, and make your life as a trader a lot less stressful, and you're going to end up with a lot less grey hairs. But again, you don't have to do any of this because the risk engine adjusts all your size at Darwin level anyway. So what the point of that is, the investor's not going to see a difference whether you increase or reduce your risk. It's just what makes it easier for you as a trader. Number 4, how to increase my risk multiplier. Again, I've already gone through this. The simple way would be to reduce your value at risk and reduce your position sizing, but it kind of doesn't make a difference, right? If I'm trying to increase my risk multiplier by reducing my value at risk, generally it's going to be, let's say I say I reduce my position sizing from 10 lots to 1 lot, and then my risk multiplier jumps up from 1 to 10. Well, I'm going to come to the same the same result anyway, because it's going to do 1 times 10 instead of 10 divided by 1. No, 10 times by 0.1, which is always going to come out the same result anyway. So, like I say, it's like a scale, and there's no way to really game that. Oh, God. Oh, God, me. And then lastly, is it bad to have a high or low multiplier? Again, I think I need to get rid of this page because I just answer them all whilst we go through the session. It's not necessarily bad, but I would just be concerned if you do have an extremely high or low multiplier, sorry, and high value at risk. There is a chance that you're kind of going to go through a significant drawdown or even blow up your account at some point. Again, that's just looking through thousands of accounts that we've had over the previous 13 years of Darwinex existing. We don't say it because it's fun to tell you that you're going to blow your account. We just say it because anybody who we've seen who operates 30% plus generally has a period, whether it lasts for a month or a year or 10 years, they have a period of time where their account kind of just goes, and whether it's permanent or temporary, it kind of depends on the trader and whether they want to come back from it. Typhoon, yeah. Also, don't stop trading if you have an issue on your account. Just talk to Kieran and the team, and they will make it right. Hacker is wounded but still trading. I promise they don't bite. Yeah, exactly that, dude. Like, my DMs are always open for anybody who ever has an issue. I can't promise that I can fix things or make everything better, but I will do my best always to make sure you at least get an answer or speak to the right person. I'm Boss Lady. Happened to me before performance fee. As in you stop trading before performance fee, or... Rob, my mate wants me to learn to trade but has grey hair. Yeah, if you've already got grey hair, you're onto a loser. I've got loads. Luckily, you can't see it on the camera, but I've got loads of grey hair. Hit a drawdown period at no point of return. Okay, so you add performance fees and then you hit a drawdown. Yeah, I mean, it happens. It's part of the game. You kind of just have to keep just keep cracking it, keep going, and just kind of seeing it as more than, that performance fee or that payout, right? I always think trading is a long-term game, but it's incentivized by short-term rewards. And that's what makes it so difficult. Like back in the day, before online funding companies were around, even before Darwinex was around, and your only way of making money was to scale a small account, right? So you'd put £1,000, dollars, euros, whatever it is, into a brokerage account and you'd try and scale it. There was not many short-term incentives to keep, like performance incentives, right? So you would be focused on the long term. You would know it's going to take me 5 years before this $1,000 or $5,000 is going to be worth a significant amount of money. might take 5 years before it's looking like 20, 30, 50, 100 grand. And so you see it long term. Whereas when we have online funding companies going, oh, you can get paid the same day as your account goes live, it reinforces that there are short-term incentives, and it makes you see things as like, not a get rich quick, but there is the possibility of, and it can really, really hold traders back, which is why I always say, don't let these short-term incentives dictate your long-term behavioral goals, or I've muddled that up massively. Dictate your behavior towards your long-term goals. I could do with a drink after my throat's in bits. Are we already muted when we join live? What do you mean by that, dude? You mean if you was to come on the stage? Typhoon, keep battling the drawdown. Keep battling the drawdown. Let me join. Now we're muted. I have no idea what you're on about, Rob. Just waiting for a couple of people to finish typing in Discord. We're muted automatically when we join the live. Yeah, exactly that. Maplin, you got it bang on. Unless you request to speak, you can't speak. Because this is a stage, it's not a voice channel. This is, for the guys watching on YouTube or X, this is specifically relevant to the Discord guys. A voice channel is where anyone can join, anyone can chat. A stage is for sessions like this, where it's kind of more of a presentation-y style thing. But just before we finish up, we are running a 10% discount at the moment using code DWX10, which is valid for all subscriptions, the monthly plan, yearly plan, or 3-year plan. With the 3-year plan, you also get a €200 discount code or coupon code for a permanent allocation. So it's of the value of a 15% permanent allocation, but you can use it towards one of the others and pay the rest. Yeah, Rob, don't worry about that. You're automatically muted, so we won't have heard any noise going on in the background. And finally, all we ask of you guys is that you spread the word, and also you let us know how you feel about Darwinex Zero, whether it's good or bad. You know, we take both types of feedback. We try and build on the good. We try and eliminate the bad. As Typhoon says, you know, I'm always open to speak to you guys and to learn what you like and what you don't like. Typhoon, naughty. Let's keep it PC. We also have a partner program, so if you have a community or a YouTube or a following, we're always open to working with you guys to help spread the word about Darwinex Zero. And for anybody who has a Darwinex Zero account, we also have a member get member scheme where you can refer your friends, family, your friends, family's dog. You can refer them to Darwinex Zero, and for everybody who you do refer, you will get a 3-month subscription to Darwinex Zero. So if you bring 12 people, you're going to get a year's free subscription. Baby in my lap, dude. What? Maplin asked in the Discord, if I need to reset due to bad performance, will my account still be tied to the previous referral code? Yes, I presume you mean the person who brought you to Darwinex. Would you still be in their kind of leaderboard and stuff? If that's what you're asking, then yes, that's correct. The only thing I would say is if you're resetting due to bad performance, have a chat with me first, because your idea of bad performance might not actually be bad performance. I've had people, believe it or not, I've had people before who I've been on calls with or chatting to, and they've wanted to reset their account because they've had a 2 or 3% drawdown, and I'm like, listen, you can't be restarting just because you've been in drawdown for 2%. Like it happens. It's completely normal. Sorry guys about all the coughing. Can we chat as a copy somewhere in YouTube? Can we change as a copy somewhere in YouTube? Try honey for bad cough. Yeah, I think I've got. Oh no, the missus threw the honey away. I actually had to go. She thought it had gone off. She didn't realise that when honey crystallizes, that's just how it stays preserved for years and years. Yeah, I got this back from 10 before I end the calibration, so it can be done 100%. I just got to enter a trade. This trade alive. As soon as you get the signal, bang. It's just one of the things I'm testing. I do a lot of playing around with automated systems. So I trade manually myself, but I get lost in building automated systems, and I've been testing one that I built over the past few weeks, and it's going well until it shorted euro dollar today. So it's unfortunate, but it is what it is. I went -3%, still fantastic. Have some whiskey, I get told. I can't drink whiskey when I'm okay, let alone when I'm ill. Whiskey is one of those drinks that cross life. Woo. I'm jealous, Kieran beating me to the algo game. I struggle with getting the logic that I want executing algorithmically. I can tend to get the logic applied to an indicator stage, but then getting everything that I want to see actually coding into executing as well. It's a different ball game. So at the moment, I'm testing with manual executions, but if it goes well, I'm happy to pay somebody to actually build it into automated execution. So whiskey, lemon, green tea brewed together always works with honey. We call it hot toddy. That sounds like it'd blow my head off. That sounds like it would blow my absolute head off. I also don't think I've got any of those ingredients downstairs. I'd have to go to the shop. Typing said I completely understand. That's why I can't do algo yet. Many bugs in my indicators that will cause a problem in algo. That's exactly the same. It's exactly the same as what I get. And it's kind of like, do you like, you can press a button or you can spend hours, days, weeks trying to code it into an algo. I'd rather just press the button. The great thing with the system that I've been building recently is it only has a specific time window. So I'm at my desk all day, every day. I have 4 screens, so it's on a screen. I can execute whenever I need to. I don't really need an EA. It would be nice, of course, but it's fine. And plus also, because it's a mean reversion strategy, sometimes it will go into, well, the majority of time it'll have a slight bit of MAE. So generally you get a better entry anyway by executing manually. But yeah. All right, guys. Well, we're going to be back in 15 minutes for an AMA session. I believe Juan is joining me. Let me just double check. Okay, Juan might be joining me. I think he is. But we'll be back in just over 10 minutes anyway. We'll be going over there is new features, but it's kind of recapping pretty much everything that everybody knows anyway. Although there is one that I'm interested to get people's thoughts on, but I think I already know what everybody's thoughts are going to be. So yeah, we'll leave that for 10 minutes. I'm going to go grab a drink and get ready for that session. So guys, thank you all for joining. Thank you for your questions. I'll leave you with a cough. Thank you all out.